April 19th, 2021, SPACs are out of favor for now. Newsletter number 4 by Max Gottlich. What even is a SPAC? SPACs, Special Purpose Acquisition Company, also known as a blank check company, have been around since the dot-com bubble. Only recently, post-pandemic, have SPACs gained an incredible influx of investment capital, primarily from Wall Street firms and VCs. In fact, SPACs have raised about $100 billion just from the start of this year. To put that number into historical context, SPACs raised about $15 billion in 2019 and $5 billion in 2015. Clearly, there is an exponential growth in raised capital for SPACs. Raising capital is all SPACs are. They do not operate as a business, which means they do not sell goods and services for a profit, i.e. shell company. SPACs raise money from investors through an initial public offering, IPO, with the mission to either merge or acquire another entity. However, if the SPAC does not merge or acquire within 2 years, the SPAC will be liquidated and shareholders will receive their invested capital. The raised capital from the IPO is redirected into an interest-bearing trust account, which will either be used for an acquisition or, in the case of the SPAC being liquidated, funds will be sent back to investors. In this way, SPACs are interestingly equivalent to a typical low-cost insurance policy, and it incentivizes and democratizes investment capital. SPACs are also advantageous because they offer a faster and less costly IPO process than the traditional IPO. Just the SPAC underwriting fees alone are significantly less than a traditional IPO underwriting fee structure. Too big, too fast? More than 50% of IPOs in 2020 were SPACs. In the turn of the SPAC frenzy, the SPAC market peaked in February and has quickly turned out of favor. In fact, the SPAC king himself, Hamath Palihapitiya, has 6 SPACs linked to social capital that have dramatically declined off their February peak. The relationship between the roaring S&P 500 and the SPAC burst continues to diverge. With record hundreds of billions of dollars pouring into the SPAC market, it shouldn't be too surprising that there is regulatory scrutiny, especially with SPAC offerings attached to exceptionally high earnings forecasts. As SPACs hit a brick wall in second quarter, the SEC in particular has been skeptical about how these SPACs perform their due diligence before a large asset purchase, their accounting standards, and their excess forward-looking valuations. In fact, the SEC has already started looking into these pressing matters as the commission started to analyze blank check companies' disclosures and other filings. On April 12, 2021, the SEC issued a public statement titled Staff Statement on Accounting and Reporting Considerations for Warrants Issued by Special Purpose Acquisition Companies, SPACs. Here is the SEC's evaluation, which clearly has widespread implications for the SPAC market. Quote, we recently evaluated a fact pattern relating to the terms of warrants that were issued by a SPAC. In this fact pattern, the warrants included provisions that provided for potential changes to the settlement amounts dependent upon the characteristics of the holder of the warrant. Because the holder of the instrument is not an input into the pricing of a fixed for fixed option on equity shares, OCA's staff concluded that in this fact pattern, such a provision would preclude the warrants from being indexed to the entity's stock, and thus the warrants should be classified as a liability measured at fair value, with changes in fair value each period reported in earnings. End quote. Until this warrant issue is fully addressed, there is a high level of uncertainty in this market, hence the recent lack of retail buying and the overall underperformance from its peak. Is there more downside risk ahead? Sure, but maybe in terms of momentum, because in the long term, prices reflect fundamentals, i.e. EPS. Not all of these SPACs will be the next Amazon. In fact, a very small percentage of them will probably fail. A very large percentage of them will probably fail. However, the opportunity to invest in SPACs early by purchasing units coupled with their enormous earnings projections, enables potentially massive jackpot returns. But there is only one Amazon and one Apple, which means the selection risk is very high in this market. With all the regulatory scrutiny evolving around SPACs, they are trading at suppressed levels and it has lost popularity quickly. However, there is no question that there's a lot to look forward to with that some SPACs offer to society and investors in the long term through their innovative capabilities and massive valuations to back upcoming developments, if anything happens. Thank you.